Everybody, welcome back to another episode on Financial Friends. Today you have joined me for another episode of the Dividend Journey. Not even sure what episode this is, but we are continuing to chug along. Although the market was green today, things are looking a little bit red in the markets overall, as kind of the next few weeks kind of come. As you can see, the market is not happy right now. It finished happy today, but over the past week and over the coming weeks, things do not look to be too great. Now, with that being said, not too much has changed in the dividend portfolio. We are staying true to our colors, staying true to what we do, which is buy dividend stocks. So, what did we do this week? As you can see, looks like the dividend yield took a bit of a hit. That is because we picked up about $25 of FISROCs. The reasoning behind picking up $25 of FISROCs was it was a position that was actually down quite a bit in the portfolio. So I wanted to get some more allocation to that at a little bit cheaper of a price. But also, we need to get closer to that 50%. We're just about there. We're almost there. As you can see here, 49.78% of MISC. And if you're a little bit new here, MISC essentially is our ETF allocation. The dividend tracker that I use, which if you want to, you can go ahead and check that out via the link in the description. But it kind of categorizes ETFs as MISC. So that's about all that has really changed in the portfolio. My strategy is evolving a little bit. If you follow Financial Friends, like the broader Financial Friends picture, you might be able to tell. I've been posting some things regarding that. There will be a video if anything is changing here in the portfolio or my new strategy. That will be definitely updated here in the portfolio. Now, as for how everything has been doing, we're going to go ahead and blow this up here, and I'm also going to minimize this, that way it's not too much in your face. So this is the overall portfolio. I did go ahead and block out an account number here, which if you are familiar with, I guess I really should be asking you all more questions. If you're familiar with Fidelity, let me know if I can show that number. If I can show that number, I will just be in my Fidelity portfolio quite a bit more often. But I'm not really sure if I can show that number, if that gives something away. So for now, it's blurred out. But as you can see, these are the exact same numbers here in terms of quantity and the amount that I have, but it shows a little bit more information. So if you're interested in seeing this as well, let me know. SPACs is going to be our cash in the portfolio. We do have a bit of cash buildup in the portfolio, which with prices going down right now is actually quite a good thing. $91 in cash, which is about 21% of the portfolio. Now that's not from sales or anything like that. That's just me kind of putting more money in as I get paid from work, kind of putting a bit more money in there, stockpiling it up. That way I can continue to average into different positions over time. I am looking to get into some type of, dollar cost average into every single position once I get all the percentages sort of back to their average weights. Again, I'm not going to be a stickler, but for now I want to make sure our ETF allocation does get up. I do want to point out a couple of things. You can see our total percent gain and loss here. Up on Apple, up on J&J, but that's about it. Other than that, we're down 3%-ish, probably average across the board. You can see down 3% here on FISROCs, down 3% here on 3M, down about 3% on O, 1.5% on SCHD, and almost 7% on Waste Management. I am going to probably go ahead, take a look at some of these individually, see if these are companies that I'm going to continue to buy into. I'm revamping a lot of my portfolios, so this definitely deserves an equal look. However, I'm pretty sure things are going to be okay there. Not too worried about it. Moving on to something that I want to touch on in a way, I try to provide some type of educational value in all of these. And an indicator that I like to use for a few of these different stocks is the current ratio. So we're going to go ahead, bring that up quickly, talk about the current ratio. So this is one of my favorite websites to use, Investopedia. It kind of is just a dictionary or an encyclopedia of all different types of terms and knowledge and different things like that regarding investing. So as you can see here, this is the current ratio section, and it's going to answer this basic question of what is the current ratio. And they'll tell you here that the current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. And I will leave that highlighted for a little bit as I kind of move down here to the key takeaways. That's really that it's going to measure current assets to current liabilities. And the way that you can kind of use that is it industry standard? That's a big point that I've made in some of my other videos is don't cross compare. So we're not going to compare like Apple's current ratio to 3M's current ratio or Apple's current ratio to Waste Management's current ratio, because those are kind of cross industry, cross sectors, and they're not necessarily comparable. It does let you know that a current ratio that's lower than the industry average might indicate distress or default. However, if it's way too high of a current ratio, that means that the group might not be managing the assets correctly. Why is that the case? Well, as we could see here, I'm going to pull up my own graphic that I have made, and I'm going to also minimize again the background, just so it's a bit easier to see. The current ratio is current assets over current liabilities. So if a company has a ton of assets and not, a ton of liabilities, and current meaning again within the next year, well, then they have a lot of cash on hand, a lot of, customer deposits or things like that coming in that they know that they're going to have, maybe a lot of equipment, a lot of supplies, things like that. Well, if you have a bunch of that, but you're not necessarily investing in anything, you're not necessarily leveling up the business liability-wise, that could be a cause for concern. Or if you have all these assets, you have all these supplies and equipment, maybe they are product or inventory, then why are they still there, right? Why aren't they gone? Why haven't you sold them yet? Again, or why are you holding on to this much cash? Why are you not making investments, elsewhere, research and development, things like that? So that can also be, some questions can be raised there. Kind of a general rule of thumb is you're looking for over a 1. Obviously, this means that the company is, has more assets than liabilities, which is something that you want to see, especially in dividend-paying companies. And so if it's under 1, that means that they have more liabilities than assets. Again, not something that you want to see in a dividend-paying company. And in general, the optimal sort of range, as you can see, 2 thumbs up or check marks there, is 1.5 or higher. Again, a general rule of thumb. It's not something that you want to be a stickler for in all different situations. And for example, if you're kind of questioning, how can I find this? How can I look it up? Well, quite simply, you can go to Google here. We'll go ahead and pull that up. And let's say, what is the current ratio of Apple? And we will go ahead and search that up. And you can see current ratio here is about 1.08. Now, I'm not a insane stat person. I don't go diving through every single website, double, triple checking, but you do want to probably look at a few different websites. So we could see this is the current ratio ending September 30th, 2021. So this isn't giving you like current Januaries. Also, if you want to go and check here, this is a different website. You can see this is Macro Trends. This here is Guru Focus, 1.07. So again, very close to that same number. And if you're looking here, you could see about 1.1 in 2021. That is indicating, again, around that same number, the 1.07 or 1.1. And then you could see here, you could also check on this website or this website, 1.07 for the quarter ending September 25th. This, again, is the same thing we've been reading, and then again down here. So there you could see that's how you might be able to find it, and you can just replace the company. So we could do Waste Management here, and we could see this has a 0.78, 0.78 down here. So again, confirming the things that we have already seen. So that was the portfolio update. That was what is current ratio. I try to give, again, little just tidbits of information within every single episode, hopefully, teaching you guys along the way, as well as exploring some new topics myself. So if you did appreciate that, go ahead and drop a like below. If you enjoyed this video and want to see more like it, drop a like below. Also leave a comment. What are some things you'd like to see? Like to see some, ETFs, or looks over different companies or more educational pieces like that, definitely go ahead and let me know in the comments below. And if you want to be informed when every single one of these new videos is coming out or a future video, check next Thursday or this upcoming Sunday as well for a new video. Go ahead, hit that subscribe button, hit the little bell beside, that way you get a notification every single time a new video is posted. And with that being said, have a great day.